Welcome to CoreLogic's update on housing market conditions for July 2017, brought to you on behalf of Credit Union SA. This month, we'll be providing an overview of the housing market conditions over the June quarter, as well as examining what factors are likely to be contributing to a slowdown in the pace of capital gains seen over the most recent 3 months of data. CoreLogic reported that dwelling values across the combined capital cities rose by 0.8% over the June quarter. That was the lowest quarter-on-quarter growth rate since December 2015. To put the weaker performance into context, dwelling values were 3.5% higher over the March quarter, highlighting a softening in the trend rate of growth over the 3 months ending March. The slowdown was mostly affected by a softer result across the Sydney housing market, where the quarter-on-quarter pace of capital gains shifted from 5% in the March quarter down to 0.8% in June. The result in Melbourne was much more resilient, with the quarterly pace of capital gains easing from 4.2% in March back to 1.5% over the June quarter. Outside of Sydney and Melbourne, housing market conditions remain diverse. Brisbane recorded the third highest quarterly pace of capital gains, with dwelling values 0.5% higher over the June quarter. Brisbane's growth is entirely attributable to a 0.8% rise in house values, which offset a 2.4% fall in the value of units over the quarter. Dwelling values slipped lower across the remaining capital cities, except Perth, which posted virtually flat growth conditions, up by 0.1% over the June quarter. Auction results have shown a similar easing over the June quarter, with clearance rates trending lower from around 80% over the March quarter to the low 70% range through June. In fact, that last 3 weeks of June saw the Sydney clearance rate fall below 70%, while Melbourne auction clearance rates hold around the low 70% mark. As housing market conditions slow, there's also been a rise in the number of homes being advertised for sale in some markets. Across the combined capitals, the number of newly advertised properties is 7.1% higher than at the same time a year ago, with newly advertised listing numbers surging 18.2% in Sydney and up by 12.1% in Melbourne. Hobart and Canberra have also seen a rise in newly advertised stock levels relative to a year ago. Sydney total listing numbers are now 11% higher than a year ago, providing more choice for prospective buyers, which should help to ease some of the urgency that's been evident across the marketplace over the past 5 years. Total advertised stock levels are generally lower than a year ago in most markets, apart from Adelaide and Canberra, where total listing numbers are up by 1.5% and 7.3% respectively. While the pace of capital gains is slowing, rental growth has been rising, albeit from a low base. Capital city rents pushed 2% higher over the past 12 months, a stark turnaround from the end of 2016 when rental growth was flat. The upswing in rental growth is mostly noticeable in Canberra and Hobart, where rents are respectively increasing at 8.4% and 6.2% per annum. However, Sydney and Melbourne rental markets have also seen a turnaround in what was previously a sluggish rental market. Rents in both cities are now 4.5% and 4.1% higher over the past 12 months. The growth in rents can be attributed to the strong and significant rate of migration coming into New South Wales and Victoria, as well as low levels of purchasing activity from owner-occupier first home buyers. Adelaide dwelling values held reasonably steady over the June quarter, down 0.2% as a result of a weaker performance across the unit sector. Detached housing showed a much stronger result, with values up 0.5% over the June quarter to be 2.7% higher over the past 12 months. That's compared with a 1.3% fall across the unit sector over the year. Selling conditions have improved substantially across Adelaide over the year, with homes now selling in 44 days on average, compared with about 52 days a year ago, as well as an improvement in vendor discounting rates. Overall, CoreLogic's June data indicates the housing market is transitioning, with the rate of capital gains moderating across what have been the hottest markets, while other cities continue to offer up a diverse performance. Sydney and Melbourne dwelling values are now 5 years into one of the strongest growth phases on record. Sydney dwelling values have surged by 79% since they started rising back in June of 2012, and Melbourne dwelling values are up by 60% over the same time frame. Prospective home buyers and regulators are likely to welcome a controlled slowdown in these markets. The slowing growth conditions can't be tied to one particular factor. The reduction in growth rates is due to a variety of factors, including the recently announced macroprudential changes from APRA, higher mortgage rates, particularly for investors, worsening affordability, and a general reduction in consumer confidence. We're yet to see the full effects of the APRA decision to limit interest-only lending to 30% of new originations. There's likely to be some way to go before lenders meet this new lending speed limit, and it's likely that mortgage rates will rise further despite a stable cash rate setting from the Reserve Bank. Discounted variable mortgage rates for investors, based on data to the end of May, are already 35 basis points higher than their recent 2016 low point. With debt levels high and rental yields generally low, it's likely that investors will continue to be further disincentivized by higher mortgage rates and stricter credit policies. It's clear that lending to investors has been easing since December last year. The latest data from the Reserve Bank shows that housing credit for investment purposes has been easing since December, which is well before the latest APRA intervention. If mortgage rates continue to move higher, as we expect they will, we're likely to see a further slowdown in investment activity. The latest figures from the Australian Bureau of Statistics indicate that investors comprised 47% of new mortgage originations, which is the lowest proportion since October last year, but substantially higher than the long-run average, which is roughly 1/3. As investment incentives deteriorate and first home buyer incentives kick in, it's likely that investors will comprise a progressively smaller component of the housing market over the remainder of 2017. The slowdown in investment numbers is likely to be impacting the Sydney housing market more than others, simply because investors comprise a much larger proportion of the marketplace than other regions. The latest ABS housing finance data indicates that investors still comprise 55% of new mortgage demand across New South Wales. Potentially, we may see some investment demand deflect to other markets where rental yields are higher, and also where capital gains are earlier in the growth cycle. With the marketplace evolving so rapidly, we recommend that you stay up to date on all the latest housing market research at www.corelogic.com.au.